You're not going to believe the tectonic shift that just hit the silver and copper markets. We aren't talking about a simple price fluctuation or a minor technical breakout anymore. President Trump has just triggered a 180-day countdown, a literal ticking clock, that could fundamentally rewrite the rules of how critical minerals enter the United States. We are looking at a potential minimum price system for silver and copper. This means the era of predatory pricing and cheap, subsidized foreign imports might be coming to a violent end. For the next 6 months, the U.S. government has set a clear path. Trade negotiations first, and if those fail, hard restrictions will follow. This isn't just a headline. It's a national security lever being pulled in plain sight. Section 232 is back on the table, and if you know anything about trade history, you know that when the government labels a mineral as a security risk, the market reacts like someone yelled fire in a crowded room. In this video, we are going to break down why the first move in price you see on your screen is likely the smallest move we'll see. The real shock? It's going to land on day 179, when the public thinks they still have time, but the smart money has already front-run the supply. We'll explain the minimum price mechanism, why even a successful deal could send prices higher, and the one specific signal that tells you institutional buyers are quietly accumulating while the retail crowd panics. Before we dive into the price floor system, I have a quick favor. I'm pushing back against the copycat channels that are ripping original work. If you value real analysis and the truth, hit that subscribe button and comment OG John AG below. Also, for real-time alerts that move faster than YouTube, join our WhatsApp channel. The link is in the description. Speed matters more than opinions right now. Price floors versus tariffs, understanding the system. Focus, explaining price floors, Section 232, and the 6-month cycle. Script starts. Let's talk about what this proclamation actually means without the fluff. This isn't just about one metal. It's about a basket of materials that power everything from weapon systems to the next wave of industrial electronics. Lithium, nickel, cobalt, and rare earths are all on the list. But silver and copper are the names that make the charts go wild. Here is the twist that most people are missing. The first step isn't tariffs, it's price floors. Basically, the government wants to coordinate a minimum acceptable price with our allies to stop what they call predatory pricing. Think of a price floor as the demand-side cousin of a tariff. A tariff adds a cost, but a price floor tells the world, this metal cannot enter our borders below this price. Period. Why does this matter? Because when you enforce a minimum price at scale, you change the entire incentive structure. Suddenly, the cheapest supply disappears, not because the metal is gone, but because the rules changed. And when the bottom of the market is removed, everyone starts fighting for the next cheapest supply. This lifts the entire price curve. The 180-day window is long enough to look reasonable, but short enough to create extreme urgency. In the first month, you'll see headlines and confusion. By months 4 and 5, when the final offers are on the table and the threats of Section 232 restrictions become real, that's when the buying spree starts. Section 232 isn't a tiny tool, it's a hammer used for national security. If negotiations become a public embarrassment, the government will use that hammer. Politics always chooses to look strong when the spotlight is this bright. So, don't assume a deal means cheap metal. A deal might be the very thing that makes the high price floor permanent and legitimate. The market chessboard, miners, accumulation, and volatility. Focus, market reaction, why bullish news can lead to selling, and the role of mining stocks. Now let's look at the scoreboard, the charts. You might see a violent sell-off even after bullish news like this. Don't let that trick you. When too many people are already long, bullish news becomes an excuse for big players to take profits and shake out the weak hands. The story can be incredibly bullish, while the tape looks ugly. Do not get hypnotized by the first candle. The real message is, what happens once the market has had time to digest the 180-day timer? If the state is leaning into pricing, one question becomes unavoidable. Who gets favored? Not every producer wins under a price floor. The winners are the compliant, allied, and strategically useful companies. This is where the opportunity in mining stocks becomes massive, but dangerous. If the government wants secure supply, it needs domestic production. If it needs production, it needs investment. And investment requires profitability. A negotiated price floor is essentially the government guaranteeing the economics of certain projects. This can re-rate mining companies that were previously ignored. But, and this is a huge but, most miners are not built the same. Some have real reserves, while others only have high-quality PowerPoint presentations. Execution pays you, noise does not. If you catch a company that gets both the metal move and the policy tailwind, you get a multiplier effect. I want to pause here and ask you, do you think the government setting price floors is a sign of strength, or a sign that the free market era is officially ending? Let me know in the comments. Also, type miners checklist if you want me to do a separate deep dive on how to filter the winners from the losers in this new strategic landscape. The final countdown, geopolitics and strategy. Focus, macro drivers, China's role, and the difference between physical versus miners. As we move closer to the 180-day deadline, the macro backdrop is like gasoline on dry grass. We are in a world where every major economy wants growth without the pain of inflation. Critical minerals have become a battlefield because metals are leverage. If you control the inputs, you control the economic engine. This proclamation is a chess move in a much wider contest for resource dominance. We are moving into a world where temporary programs often become permanent institutions. If the US wants less dependence on foreign choke points, it will push investment into domestic refining and secure processing. This means long-term contracts and guaranteed offtake agreements. If you are only watching the spot price, you are missing the deeper current. So, what is the play? Physical metal is about ownership and removing counterparty risk. It doesn't depend on a CEO or a permit. Miners are about leverage. They can move more than the metal, both up and down. If your goal is safety, lean physical. If your goal is upside, research the picks and shovels. But whatever you do, stay awake. The 180-day timer is a psychological weapon designed to force buyers to secure their supply now. Narratives will collide. One day the headlines will scream, "Crisis averted," and the next day they'll say, "Talks stalled." Price will swing to punish anyone making late, emotional decisions. Stay grounded by asking 3 questions every week. What did policy do? What did the big industrial buyers do? And what did the price do after the initial reaction? If you can answer those, you'll be years ahead of the crowd. By the time you see this, my members-only video is live with a deeper breakdown of this countdown. Join the membership to see how this evolves. Remember, the board is changing, and the first movers are the ones who get paid. I'll see you in the next update.